Hello everyone, this is Dr. Mihir Shah once again with another video. In this video we are going to solve the case study problem which had come in university past paper in the year April 2019 under the subject investment analysis and portfolio management. A very important video for all the TYBMS SEM V student. So in this video we are going to take up the case study question that had appeared. Okay, we'll read it out and we'll try to see what are the questions they are asking us to find and what would be the appropriate answers. So chalo, let us go ahead and check which case study had appeared. So the case study reads as a portfolio management consultant, you are approached by Mr. Thakur, age 45, with investable fund of 35 lakhs. He wants to know from you the following: what are the investment avenue available to him which will give a suitable return and minimum risk, and what are the various types of risk. Now whenever you get such kind of question, always remember first divide the answers in multiple stages. First stage, only note down the characteristic. So age 45, investable fund is 35 lakhs, occupation working individual with stable income, risk appetite will be moderate, seeks good return but prefer minimum risk, and investment horizon will be medium to long term. Those are like fixed pointers. Objectives of investor: stable and suitable return, minimum risk, capital appreciation, liquidity, and provision for old age. So according to that, 35 lakhs ka, this is what we have broken up the investment avenues. So we have amount invested, fixed deposit 8 lakhs, bond 7 lakh, mutual fund 10 lakh, provident fund PPF is 5 lakh, life insurance 3 lakh, and NSE 2 lakhs. The total comes to 35 lakhs. Okay, so these are the first. So first we note down the characteristic, then we note down the objectives, and then we have taken the investment avenue. First go through this. Okay, I can note it down. Then we have to explain now all the types of avenue, the meaning with merits and demerits. So till then first go through, then we'll come to the next slide. Okay, so the next, now we are explaining. Okay, fixed deposit 8 lakhs rupees. Fixed deposit offers stable and guaranteed return to a very with a very low risk. They provide good liquidity and premature withdrawal as possible in emergency. Merits: safe and risk-free return, stable return will get 6 to 7%, easily encashable. Demerits: lower return compared to equity or mutual, and no capital appreciation. For bonds and debentures 7 lakhs, investment in government or reputed company bond provides steady interest income with low risk. The merits are regular fixed income, negligible default risk, and demerits are no capital appreciation and sensitivity to interest rate changes. Mutual fund 10 lakh. So Mr. Thakur can invest in debt oriented or hybrid. So debt may be at put 6 lakhs and hybrid is 4 lakhs. Merits: diversification of risk, professional management. Demerits: no direct control and subject to market fluctuation. Next is PPF 5 lakhs, tax free returns and an act as provision for old age. It has lock-in period of 15 years. So merits: minimum risk, tax benefit. Demerit is long lock-in period and limited liquidity. Life insurance 3 lakhs. So life insurance give financial protection to the family and also act as an investment if chosen as an endowment or pension plan. So under merits, you can have life cover and security for family. Benefit you get under ATC, low, but demerit low return compared to any other market linked scheme. And lastly, NSE 2 lakhs is a government backed savings scheme with guaranteed return and tax benefit. Merit is low risk, benefit under ATC. Demerit is fixed lock in period and limited liquidity. So these are all the avenues ka merits and demerits with a small explanation. You can go through it once. Okay, and lastly we have that conclusion. So conclusion is show that fixed deposit is 8 lakhs, bond is 7 lakhs. Okay, mutual fund 10 lakh, PPF 5 lakhs, life insurance 3 lakh, national saving 2 lakh, total is 35 lakhs and 100%. Thus the above portfolio provides a balance, stability, safety and moderate growth suitable for Mr. Thakur's need. Okay, you can go through it once. Okay, and lastly they are even asked you what are the various types of risk. Now in risk there are two types of risk. One is systematic risk and unsystematic. Under systematic we have market risk, interest rate risk and inflation risk. Unsystematic may we have business, financial and default risk. You can go through it once. Okay, so I hope everyone have noted it down. So with that we will be ending this video here. Thank you.